Abhay Agarwal joining us now, Managing Director at Piper Serica Advisors on all things market. Abhay, pleasure as always to speak with you, and thank you so much for your time to us here on NDTV Profit. I mean, mixed kind of view on results so far, save and Eternal, where actually if you look at it, there is a drop in profit. So the street wants to see the metrics that they want to see.
Yeah, good morning, Tamanna. Yeah, I think so. I think it's been a mixed bag. As expected, largely, I think the result season, we have seen the heavyweights come up so far. So I think the smaller companies, growth companies would start announcing their results from now on. I'm expecting some pickup there. I'm expecting that some of the smaller companies across sectors would have better numbers than the larger ones. Eternal, of course, it's always been a play on the size of the company and the size of the market that it serves, and how big it can get, both through its quick commerce and delivery business, food delivery business. So I think that's what the market is rewarding the company for, that it is not just focused on profitability, but gaining a larger and larger market, creating the market, I would say, instead of creating market share, just creating the market. So I think clearly the growth investors are happy with that outcome, that the company's quick commerce business has grown faster than expected. And I think that's what, all the internet consumer companies are going to see these kind of numbers this quarter, is what we believe.
Internet companies, you will continue to see buzz. What are you liking here? Whatever you can share with us, Abhay, because Info Edge also up, Swiggy also up today, Eternal. It's like, the tide is lifting all boats.
Yeah.
Some concerns about whether the economics of it is working, but do you see those concerns at all?
No, I think those concerns were there when these stocks listed, when these companies listed, not that far back. And I think some of the investors who burnt their fingers at that point of time are still kind of cautious that, the unit economics there were quite broken. But the unit economics, if you see now, they are largely falling in place. These companies are now marginally profitable at the unit economic level, and some of them are quite profitable. So in fact, we have been studying this space for last 6 months, and we have added in our model portfolio 2 companies. These are not my buy recommendations, but since our model portfolio is something that we disclose, so I can share. One of them is Cartrade, which has already done well, and there's another one that we are still in the process of adding. So I think we are going to go a little overweight on internet consumer companies, because we see a massive shift now kicking in, the operating leverage that these companies built. And you have to remember, this is a winner take all market. And I think these companies have gone through the valley of death and have emerged stronger and are getting stronger. And they're a great play on India's consumer story, So rather than buying an FMCG company, maybe better to look at these QSR companies, or, if rather than buying an auto company, look at a car trading company or an insurance company. So I think these businesses are set for scale. And that's how investors like us are looking at them, not focusing too much on the traditional valuation metrics. I know it is a lot of people would say that it is a risky bet, but I think these are the growth engines that in a market like India, you can't miss.
So now let me ask you the complete opposite of this new age, non-traditional plays, which is your banks. Can't get more traditional than that, especially your large private banks that seem to have surprised on the upside. How have you looked at some of the numbers that are coming in, and are you feeling comfort with banks, considering that we've entered a low interest rate regime now? Your margins are going to get hit in the quarters to come.
No, we are very positive on banks now. I think we have seen the worst of the credit cycle in probably the quarter that ended March. And the results, I think, now are still not reflecting the recent recovery in the credit cycle and in the asset quality cycle. There are always going to be legacy issues for the book that was in the loan book that was there till September of last year. So those collection will struggle. But what we have seen is all the new book that has been built from September 24 onwards, the collection efficiency is very good. So I think barring the old book problems that will kind of resolve themselves over a period of time, the new book is looking good. So we are for after a long time overweight on banks. We have added four banks, small banks, but to our portfolio because we believe that the valuations there are more attractive and any positive surprise will re-rate the smaller banks better. But it is heartening to see the performance by the large banks so far, the industry leaders. I think it is on the right track, and I think the next quarter numbers will be even better, and the commentary will be even more stronger.
You would continue to favor private banks versus the public sector players?
Yeah, public sector is they have their own merit, Tamanna, so you can't rule them out. But the problem with public sector is that they are unpredictable. The quarterly volatility is very high. So that is why we prefer the private banks because they are run for shareholder value maximization. And I think the public sector valuation, public sector bank valuation has also largely caught up, so there is no arbitrage left between the public sector and private sector banks really. So I think the opportunities in the private sector banks are more appealing right now, the smaller ones and mid-tier ones, rather than public sector banks.
Just wondering how you're looking at the whole capital markets play as well, Abhay. A lot of back and forth on Jane Street. That was a bit of a downer. But now that things seem to have been sorted there, the fine paid, they will be back with conditions, etc. Will you be looking at a renewed fervor, renewed interest in capital markets?
So I think we call these capital market infrastructure companies, and we have companies like CDSL, CAMS, Angel One in our portfolio for, I think, since the time they listed pretty much. And the reason being that, as the Indian capital market grows and from a $5 trillion market cap, we go towards a 7 trillion, 8 trillion, $10 trillion market cap. These are the companies that will continue to do well because they are critical for expansion of the capital market activity. So as more investors, new investors come in, as existing investors scale up, more mutual fund schemes are launched, more SIP accounts are opened. All these companies benefit because they are highly tech oriented. So the marginal cost of delivery of business is not the same as the increase in sales. So the margin keeps expanding. They have generate high cash flow. So we like that space. I think it's a long-term play. On the exchanges, they are part of the same setup, but the problem is that they are more volatile. One Jane Street going out of the play impacts volumes. So exchanges will definitely be a critical part, will be more volatile, but at the same time, the depositories and the RTAs and the brokers may be less volatile is what our view is.
Okay. In terms of what you're liking right now, Abhay, where would a pharma sector sit on that? Would you be looking at a slightly more defensive play? Because apart from a good spike that we saw yesterday, markets have been very cautious. Are you also trending to a little bit of a more defensive play?
Pharma has been an overweight for us for last 2 years, Tamanna, and I think last year it was the best performing sector. We benefited, and this year also we are actually looking to add more names wherever we can find them. We are looking for more innovators. So I think if we break up the pharma segment, there are generic exporters, large generic exporters like Dr. Reddy's, Lupin, Cipla. I think they will continue to do well because they have very robust new launches pipeline in the US especially. And the US market is very receptive to Indian pharma companies. The US FDA is very supportive of them. So I think these guys are in a purple patch and they will continue to do well. But the action, the real excitement is to back innovators and CDMO companies. I think that is where you will find companies, like what Dixon did for its shareholders. We expect, large CDMO players getting larger to do for their shareholders. So I think that is where interest is more right now. And I don't see them as defensive stories. I see them as growth stories. You have to, there are mid-cap companies, but if you can catch them at the right time, I think you have multi-baggers, and some of them have listed recently. So they will go through their own value discovery phase in the markets. But I think pharma is going to be an outperformer just like last year, I think this year also, and probably next year.
Okay, so pharma continues to be the outperformer. You like CDMO specifically, liking platform companies. Are valuations concerning you at all, Abhay? Since you spoke about Dixon, and that is one concern that comes in. Are valuations concerning you? Because it seems to be the same stories that the market is betting on.
So, Tamanna, I think these are all growth stocks, and India is a growth market. So that's how international investors look at India. They don't look at India as a value market. So, and even for on-ground managers like us, we have all made our money off backing growth. You look at a company like Dixon, again, not our buy recommendation, though part of our model portfolio, but it has always been expensive. Since it listed, it has traded at a multiple of 80, 90, sometimes more than that. But we have seen the market cap become 10 times of what it was 5 years ago. So that is why I think in some of these companies which are mid cap, small cap, trading at a market cap of 5,000, 10,000, 20,000 crores, I think the investors have to not look at the immediate price earnings multiple or traditional valuation matrix and compare them to their larger counterparts. But the bet they have to make is that, look, is the space so big, and are these companies going to create a category which will take the market cap from here to 5 times of what it is? And if the answer is yes, then I think the focus should not be so much on traditional valuation matrix, but more on growth and what that growth can drive the market cap to be.
Focus on growth, maybe a higher tolerance to valuations building up. It's interesting you say that, Abhay, because you were having that conversation earlier in the day in regards to Zomato. And someone on our channel said that there are some companies where you shouldn't be obsessed by valuations. Just as a last parting shot, is that something that you agree with?
Not wholly, because obviously, Tamanna, we don't want to overpay and then repent.
Some companies.
Yeah, no, some companies definitely, and I think that's the beauty of the Indian market. That if you are willing to focus only on growth and spend a lot of time analyzing a company for its growth prospects over next 3 years, 5 years, that has always been the way to make money in the Indian markets. You go back, look at the portfolio of say since we are talking Rakesh Jhunjhunwala, Titan. When he made the bet on Titan, it was probably an expensive stock. But then the money was made when Titan went from 1,000 crore market cap to 250,000 crore market cap there. So I think that's where you have to focus on, and then just focus on growth. Keep those companies in the portfolio. Don't try to trade in and out based on valuations. And I think that is how investors will get rewarded.
Completely. Thank you so much, Abhay Agarwal, there of Piper Serica. Always enjoy our conversations.